Today, the greatest crime in financial history reached its climax. Wednesday, December 10, 2025, at exactly 9:30 a.m. Eastern Standard Time, the global banking cartel did something they haven't done in half a century. They surrendered. Look at your screen. Spot silver is trading at $61.75. That is not just a price, that is a crime scene. That is the sound of billions of dollars of naked short positions vaporizing in real time. That is the sound of Bank of America, J.P. Morgan, and their entire cabal realizing that the paper game is finished. The Maginot Line at $60 has fallen. And what lies beyond $60 isn't resistance. It is a graveyard for the banks and a paradise for the patient. The mainstream media is going to call this a squeeze. They are going to call it a bubble. They're going to blame Reddit. They are going to blame India. They might even blame you, but you know the truth. This isn't a bubble. This is a jailbreak. The price of silver is finally doing the one thing it was illegal to do for decades. It is telling the truth. In the next 30 minutes, I'm going to document the autopsy of the greatest short squeeze in human history. I am going to show you exactly how much money the banks are losing every single time the ticker ticks up 1 cent. I am going to explain the commercial signal failure, the technical event that confirms the manipulators have lost control. And I am going to show you why $61 or $75 is not the top. It is simply the starting gun for the run to $100. If you held on, if you stacked when they laughed at you, if you bought when the price smashed down, this video is your victory lap, because the banks just lost the war. To understand the magnitude of today, you have to understand what $60 represented. In military history, the Maginot Line was a series of fortifications built by France to stop Germany. It was supposed to be impenetrable. For the bullion banks, $60 was their Maginot Line. Why? Because above $60, the math of the derivatives market breaks. You see, the banks don't just sell silver, they sell contracts. The standard COMEX contract is 5,000 ounces. When a bank shorts the market, they are promising to deliver 5,000 ounces at a future date for a set price. For years, whenever silver got close to $30 or $50, the banks would sell millions of these contracts. They would print paper silver out of thin air to flood the market, scare the buyers, and drive the price down. It worked in 2011. It worked in 2021 during the silver squeeze. But this strategy relies on one thing: fear. Now, look at the reality they tried to hide. The Silver Institute reported a deficit of 237.7 million ounces in 2022. In 2023, another 140 million ounces. In 2024, the deficit widened again to 215.3 million ounces. And as we close the books on 2025, early projections show we have burned through another 200 million ounces. Add that up, since the start of this decade, we have run a cumulative structural deficit of nearly 800 million ounces. But wait, that's just the reported deficit. That doesn't account for the investment drain. The silver pulled out of ETFs and moved into private storage. When you add the drain from the LBMA vaults, which plummeted 30% from their 2021 peak, when you add the retail stacking frenzy, the real number isn't 800 million. It is over 1.1 billion ounces. Think about what that means. The entire global mining industry produces about 830 million ounces a year. That means for the last 5 years, we have been short more than an entire year's worth of global production. Where did the extra silver come from? It came from the ghost inventory. It came from the billions of ounces sitting in London vaults, legacy stockpiles from the 1990s, and government hoards. We have been cannibalizing our savings account to pay our daily bills, and the banking cartel loved it. As long as there was ghost silver to bleed into the market, they could point to the vaults and say, "See, plenty of metal. No shortage here." But math is undefeated. You cannot run a deficit forever. Eventually, the savings account hits zero. That is what happened this week. That is why we broke $59. The ghost silver is gone. The LBMA float, the metal actually available for lease, is effectively zero. The COMEX registered inventory is down to fumes. Now, every new solar panel, every new cruise missile, every new iPhone has to be built with silver that was mined yesterday. There is no buffer. There is no slush fund. And when you have a market with inelastic demand that must be met regardless of price, and you remove the supply buffer, price doesn't adjust linearly. It goes vertical. The 1.1 billion ounces didn't just vanish. They were the anchor holding the balloon down, and the rope just snapped. But wait, the skeptics say, if silver hits $60 or $80, surely demand will crash. Solar manufacturers will switch to copper. They'll use less silver. This is the single biggest lie on Wall Street right now. And I'm going to destroy it with one acronym, Top Gun. For years, the solar industry used a technology called PERC. It was efficient enough, and it used about 10 milligrams of silver per watt. But PERC had a wall. It couldn't get any more efficient. And in the energy game, efficiency is everything. So, the industry pivoted. In 2023 and 2024, the entire global manufacturing base shifted to TOPCon and HJT cells. Here's the problem. The longs, the people holding the contracts, smell blood. They aren't selling at $61. They are waiting for $70. So, the bank has to bid higher. They are bidding against themselves. They're bidding against other panicked banks. This is a short covering rally. It is the most violent type of price move in financial markets. It has nothing to do with fundamentals anymore. It has to do with survival. Bank of America specifically is the elephant in the room. According to the Office of the Comptroller of the Currency reports from 2024, Bank of America had increased their precious metals derivatives book massively. They were the short of last resort. They absorbed the shorts that JP Morgan dumped. Today, Bank of America is staring into the abyss. At $61, at $75, their derivatives book is a nuclear bomb ticking in their vault. They have to cover, and their buying is what will push us to $70 by Friday. This is the anatomy of a default. The paper leverage that suppressed the price for decades has just reversed. Instead of leverage pushing it down, leverage is now a rocket engine pushing it up. Traders, listen closely. If you look at the technicals, we just witnessed a commercial signal failure. For 40 years, the pattern was predictable. Silver price rises, banks increase short positions, price crash, wash, rinse, repeat. It was a money printing machine for the trading desks. But look at the data from the last 2 weeks. As silver rallied from $55 to $60, the banks did not add more shorts. In fact, the open interest declined. Do you understand what that means? It means they stopped fighting. It means they looked at the tidal wave of buying coming from the east and said, "We cannot stop this. This is a signal failure. The machine is broken." The algorithm that managed the price has been turned off. Why? Because of the Basel III Net Stable Funding Ratio, NSFR. We talked about this years ago, but now it is biting. The new banking regulations make it very expensive for banks to hold unallocated paper gold and silver liabilities. They need physical backing, but the physical backing is gone. So, the compliance departments at these banks tapped the traders on the shoulder and said, "Get out. Close the position. We cannot afford the capital charge." So, the banks aren't just losing money on the trade. They are being forced by regulators to exit the trade. They are forced buyers in a market with zero inventory. This is why $61.75 is different from $50 in 2011. In 2011, the banks were fighting to kill the price. In 2025, the banks are fighting to exit the building before it burns down. When the manipulator becomes the beer, there is no ceiling. Why? Because the Indian whales saw the deficit coming. They saw the 1.1 billion ounce hole before we did. They knew that the solar factories being built in Gujarat would need massive amounts of paste. They knew that the Gift City Exchange was opening up to challenge the West, so they bought the bottom. They bought when silver was $22. They bought when it was $24. They cleaned out the London vaults while the LBMA was asleep at the wheel. And now that silver is $59, you might think, oh, India will sell. They'll take profits. No, because in India, silver isn't a trade, it's wealth. It's the poor man's gold, but it's also the rich man's industrial input. The silver that went into India isn't coming back. It has been turned into jewelry or it has been consumed in electronics factories. It has left the free float. This is the key to the 1.1 billion ounce narrative. That silver didn't just vanish into thin air, it moved from weak hands to strong hands. The West is now waking up to a shortage, realizing they sold their insurance policy to the East for pennies on the dollar. JP Morgan knows this. They track the flows. They saw the 73 million ounces leave in February 2024. They saw the thousands of tons leave throughout 2025. Why do you think they stopped shorting? Why do you think the tamp down stopped working? Because you can't spoof a market that has no metal. You can't flash crash the price when India is standing there with a bucket ready to buy every single dip. The Indian whale broke the back of the short sellers. And now the West has to pay the price to get any metal back. So here we are, December 9th, 2025, $59. What happens next? We enter the vacuum. In technical analysis, resistance is created by people waiting to sell. If you bought silver at $30 5 years ago, maybe you sell at $30 to break even. That creates resistance. But who bought silver at $65? Who bought silver at $75? Who bought silver at $85? Nobody. There is no overhead supply. There are no bag holders waiting to get out. This means that technically the sky is clear. This is what we call a blue sky breakout. When an asset clears its all-time highs, it enters a phase where the only way to find a seller is to bid the price up. But there's another target, a target that the 1.1 billion ounce deficit points to directly. $100. Why $100? Is it just a round number? No. If you adjust the 1980 high of $50 for inflation, using the government's own rigged CPI numbers, that $50 is worth roughly $170 today. So, at $59, silver is still historically cheap. It is still 60% below its real all-time high. But psychologically, $100 is the magnet. The vacuum effect works like this. First, the shorts cover. The hedge funds that are still short have to buy to close. They don't care about price, they care about survival. Second, the FOMO. The retail public who ignored silver at $25 sees $60 on the news. They rush in. Third, the industry panic. This is the big one. When Tesla and Samsung realize the 1.1 billion ounce buffer is gone, they stop buying just in time. They start buying just in case. They hoard. Hoarding creates scarcity. Scarcity creates higher prices. Higher prices create more hoarding. It is a feedback loop from hell for the banks and a feedback loop from heaven for physical owners. The 1.1 billion ounces that vanished created the conditions for this vacuum. And nature abhors a vacuum. Price will rush in to fill it. I believe we will see a rapid move from $59 to $75 before the end of the year. And $100 is not a 2030 target. It is a 2026 target. The 1.1 billion ounce deficit wasn't an accident. It was a transfer of wealth. It was a transfer from the impatient to the patient, from the paper believers to the physical realists, from the West to the East. For 5 years, the data was screaming. The Silver Institute reports were public. The LBMA vault data was public. The India import numbers were public. Everyone had the chance to see the whole forming. Everyone had the chance to buy silver at $22, at $25, at $30, but they listened to the TV. They listened to the banks. Now the buffer is gone. The line at $59 is broken, and the vacuum is pulling us higher. If you are watching this and you still hold paper and allocated accounts, SLV, pool allocated, you're standing in a burning building hoping the fire insurance company is solvent. Get the metal if you can still find it because the 1.1 billion ounces that vanished are never coming back. And the next billion ounces, they are going to cost a hell of a lot more than $59. The squeeze is incoming. The squeeze is here. I'll see you at $97. Subscribe.